All right, welcome back, guys. Good day, and thank you for being a part of this class up to this point. Just want to appreciate you because I know it's not easy putting in so much time and effort and resources as well, because I know some of you paid for this course. So I want to quickly go into the rest of the indicators that I use often. I've told you already in the last video that my major indicator are the moving averages. And after the moving averages, I have a few other indicators that I use for confirmation and for trade entry. So in this video, I'm just going to talk about a few of the other indicators. I'm not going to be going too deep into them except for the ones that I use too often. I'm going to be talking about the Fibonnacci, which I use for retracement and extension. We'll talk about that briefly. And then I'm going to talk about RSI and stochastic. Those two I don't use very often, but for those who are interested in using them, you could learn about them. It's good to know about them because they are some of the some of the popular second level indicators. And apart from that, if time permits, I'm going to talk about the awesome oscillator as well. The Williams awesome oscillator, which is one of the indicators that I use as well for confirmation. Okay, so having said that, I'm going to go straight into the lesson for Fibonacci. So I'm going to start with Fibonacci, Fibonnacci. I don't mind all this scribbling, because of the way. Okay, let me write it neatly. Fibonacci, double C. Fibonacci. Okay, now Fibonacci is one of the sweetest indicators for confirmation. Okay, for confirmation. Now there are two types of indicators. There are lagging indicators and there are leading indicators. Okay, lagging indicators. Now lagging indicators are indicators that respond to market activity. Okay, they lag. That is, they come to play after the market actions or market activities have been implemented already, which means they follow the market activity. So when market does this, then they will do this. Market does this, they do this. Market does this, they do this. So those are lagging indicators. For instance, when somebody is lagging behind, it means the person is probably following you, or the person is following your example. Okay, now we have other indicators that we call leading indicators. Now you know what it means for something to be leading. Okay, for something to be leading means the object or the item is going ahead. Okay, now leading indicators are indicators that are going ahead of the market, that can predict, based on what you have drawn, that predicts what's going to happen next. So moving averages are actually lagging indicators depending on the period that you use, but they are a lot more accurate lagging indicators. Now, what's the name? Fibonacci is one of the few leading indicators that we have in the market today. One of the few leading indicators that we have. Now, I will show you how Fibonacci is leading, and then you can now compare it with what moving average does, and then you can now see how you can use moving average with Fibonacci together to get a lot more accurate entry and exit of the market. All right, I'm going to switch over to the MT4 quickly, and then I'm going to show you how Fibonacci is used and how to bring it in on mobile devices, how to draw it, how to interpret what you are seeing, and how to use the information you are seeing as well. Okay. Okay, here we are on MT4. We still have our moving averages from the last classes. Okay, now if Fibonacci would do, when trend is going in a direction, like for instance, now if you look at this current trend now, you see that this trend is going in one direction right now. Now it's going up at the moment. But there are two things a trend is doing. It's either it's going to keep going in that direction. That is, when trend starts to go up like this, it pulls back, goes up, pulls back, goes up, pulls back, goes up. So there are two things that the market will do. It's either it will continue to go in the current direction, or rather there are three things it will do. Either it continues to go in the current direction, which is 1, or it will do a major retracement, which is 2, or it will change direction completely, which is 3. Okay, 1 is to continue in that direction, which is what it did up to this point. Okay, let me just remove all those scribblings for a bit now. Now, like I said, there are three things the market will either do. Is either it will continue in the same direction, which is what it did at this point, or it will do a major retracement. This is a really major retracement. So this is one activity. This is the second thing it could do, and then continue, or it could change trend completely, which is the third thing that the market will do. Okay, now Fibonacci helps us to understand when it's a retracement and when it's no longer a retracement, when it's a complete reversal. Usually I would use Fibonacci for two things. Number one is to know, I'll use Fibonacci when the market is already retracing, to know when the retracement will end, when these two will end. That's one. Secondly, I'll use Fibonacci to know how far it will go after this retracement up before it will stop. Are we together? So one is to know when this will end, and second is to know, sorry, let me change the color of that so one is to know when this will end, and the second one is to know how far it will go at the end of this. Okay, so this is what I use Fibonacci for, and we're going to look at it together right now. Now let's assume that the market was currently at this point. It had finished going up and was retracing already by this time, and I saw the market at this point. I want to know how far this retracement is going to go. Is it going to stop here? Is it going to continue up to this point? Is it going to go all the way to this point? Or is it going to just continue until it pulls all the way back beyond where it started? Now what I would do is to bring in Fibonacci. Now to bring in Fibonacci, what Fibonacci will do for me is to draw that line. So to bring in Fibonacci, I'll just go to my indicators. No, sorry, not indicators. Let me go back there. I'll just go to my objects where we usually draw the horizontal lines. Okay, I'll click on the plus and then scroll up to where I have Fibonacci retracement. There are different types of Fibonacci, but I'm going to focus on Fibonacci retracement for now. Even the Fibonacci extension, we'll still use Fibonacci retracement to get the extension, so forget that, you won't see Fibonacci extension here. So Fibonacci retracement is what I will pick. Then I will start from where the the trend started, all the way to the highest point I can see as at that time. Okay, now note what I'm doing. Even though I slanted a little to the right, check the last line at the top. You see those blue lines? The last one, I'm making sure that it's going to align with the tip of that last candle. Now when we're using Fibonacci, when we're drawing Fibonacci, we do not use the line chart for this. We always use candlestick charts because we want to factor in the wicks. Okay, we want to be sure that we factored in the wicks. We don't want to exclude the wicks from our drawing, because without the wicks we might not get the right reading. So I am aligning it with the beginning of the bottom of the last wick and the tip of the last wick that we have up here as well, as you can see. Sorry, I'm trying to zoom in. Okay, so here we are. I have from this point to this point. Now the easiest way to draw this is to make the line, the red line, which is the line that marks the length of your trend, to make it align with the trend that you are working with. Right now I've done the opposite of that. It might be a bit confusing, because if you are not a seasoned trader and you look at this chart, you will not understand where this Fibonacci is drawn for, or why or where you drew the Fibonacci from. So I'm going to align it the way I would expect to align your own now. So to move it, just click on the dot at the tip of it and move it to where it's supposed to be. And as you can see in the corner there, in the left hand corner of the screen, which is this point, if you look at this point of the screen while I am drawing the line, you realize that there is a small box there showing you when you have reached showing you the wick, the candle that you are currently on and where it is. So I want you to pay attention to that point as I adjust the bottom part of this Fibonacci now. So I'm going to pick it up and take it to the bottom, and you see that as I'm moving around, it's showing me a zoom in of where I'm seeing. Even though my finger is resting on it, I can't see clearly, but with that box I can see now. Now I have aligned this Fibonacci neatly. Now Fibonacci retracements follow several levels. You see those lines, you have the 23, the 0 point, which is the end of the trend, the 23, which is the first retracement level, the 38, which is the second retracement level, the 50, the third retracement level, the 61, the fourth retracement level, and the 100, which is the final retracement level. Now the highest retracement level you will get is 100. Usually it is possible for market to retrace as far as where the trend started before it starts going back up again. It happens a lot. Now, the further the retracement, the higher the trend will go. What that means is this: if my retracement only goes as far as 23, that means when it's going back up, it will not go so high up, as against if my retracement had come all the way to 50. If my retracement come all the way to 50, then the continuation of that trend will be longer than if my retracement had stopped at 23 or 38. Okay, and if it comes all the way to 61, we're going to expect a longer move in the opposite direction as well. Okay, so that is what I want you to pay attention to. Now let's try and interpret the current Fibonacci readings that we have on the screen. This current Fibonacci reading went a little beyond 23 but did not get to 38.2. Okay, now I'm not going to tell you how Fibonacci numbers came into being. You're going to find them in the PDF material I gave you. So go back and read on Fibonacci on that PDF material. You will see a lot of explanation on how Fibonacci numbers came to be. So I'm not going to talk about that too much. Now, what do we notice? We notice that the moment the retracement continued, and after we drew the line, we saw that the Fibonacci retracement came all the way to 23. If we draw that same Fibonacci retracement for the retracement now I want to get the extension. I will pick it from where this one ended and brought it to the beginning, to the end of this other one. That is where the retracement ended, when it has finally ended. Now this time around, what I'm looking for is not, sorry, I picked the wrong thing. Good. So what I'm looking for now is not what do you call it? Is not a retracement anymore. I've seen the retracement already. The retracement has ended. Now the retracement has finished and it has started going back up. What I want to find out now is from this zero, how far is it going to go up? Okay, so that is what this other retracement that I just drew now is going to show me. Now what this is showing me is that it's going to go up to the next very extension. We saw that in the retracement it retraced up to the first after the zero, the first retracement level after the zero. Then when it's going back up, it's only going to go back as far as the first extension level after the zero as well. This is the 0 point, which is also the 100 point. Let me put a line there so that you know what I'm talking about. I'm putting a line here. Sorry, I need to make that line thicker. Okay, now I put a line at that point that we're using for all our calculations. That is where this trend ended, and where the zero is for the end of this retracement. Okay, this retracement here, this is the zero for that retracement. Okay, so now what we are looking for is how far is this one going to go now? Is it going to go as far as 1000 pips, 700 pips, 500 pips from the beginning? Now this is where this retracement now comes into the picture. So I'm going to drop down to a smaller time frame. We are currently on a weekly, so I'm going to drop to daily to make it easier to I hope it will be easier to read from here. Yes, so I'm going to drop down to 50, to daily, and then we can look at it again. So you see that the highest retracement we got was this point. Now, having gotten a retracement up to this point, how far do we expect it to go up? We'll be looking at the same distance from here to here, from this point to where it will stop up there. Okay, so what that means is this: if I get 100 pips from here to here, from here to this 23, I should be looking at 100 pips from the end of this line when it finally breaks this level to this point as well. Do we understand? If I get it as far as 38, I should be looking at something longer than this all the way up. If I get it as far as, well, maybe 61, I should be looking at a much longer line up there. Okay, so how do we trade this now? What I'm trying to trade is this. If I want to trade the extension, there are two ways to trade it. You can trade the retracement, which is you wait for the retracement to complete. When the retracement completes and it's going back up, then you can trade from here, from this point to 0, which is one way to trade retracement. Now, a second way to trade is to wait for this retracement to complete, then trade from this retracement point, from the end of this first trend, the end of that trend that it retraced, to as far as it came at this point. That will give me a better trade than before. Okay, so this is the beauty of using Fibonacci. Now, one other beautiful thing is this: when you combine Fibonacci with moving averages, you get a more accurate reading. How do I mean by that? I'm going to remove this extension for a minute. Okay, now I've removed the extension. Now, if you look at this Fibonacci extension, when I drew the retracement initially, I have my moving averages 14 and 50. Now notice how 14 and 50 crossed just above the 23. That cross is telling me that this retracement is going to go beyond that 23. That means it will break below the 23. But right below the 23, I have the 200 EMA and the 800 EMA about to cross in the opposite direction as well, which means that whatever pull down I'm seeing here will not last for long. So this is a very important confluence in Forex. When you have your Fibonacci level aligned with moving average crossovers about to happen or happening at the moment, then you would be careful about how to trade that section. So the moment I see this cross, yes, I expect it to continue down because it's crossing just above 23, fine. But then look at the distance between that cross and the 200 moving average. Remember, our 200 moving average is okay, I think that is gold. Our 200 moving average is this thin gold below here. Let me edit it a little to change the what's it called? Let me change that thickness so that we know the difference between 200 and the 800. We have two moving averages there. Let's see which is this 200 gold. Okay, let me increase the pixel size to maybe 3, and then I'll also increase the one for the 800 to 4. Okay, now this way I can easily differentiate between the two of them. Okay, so now we have seen 200 struggling all the way up. It's been struggling from down here to go and cross over. It's been struggling from down here facing up already, and 800 is just going on its merry way while 200 is moving up. Now when we see this cross at 23 here, it tells us that because of this moving average that is facing up, this cross, you remember what I said about moving average crossover, that when moving averages cross, wherever the 14 cross to, if 14 crosses over 15 down, then we're going to have a continuous downtrend. Now 14 crossed over 50 at that point, and it actually continued down, but because of the position of this 200 preparing to go up, it's not going to last for long. That means the cross is not going to cause a long pull down, and at the same time you see 23 waiting for you at that same point, 23 retracement level waiting for you at that same point, which means it would not last for long as well. So we will close this, and then even if we are going to take a sell here, I would not take a sell here, but rather I will wait for this retracement to complete and see where it finally ends. When it ends by bouncing off 200 and 23 moving average, 23 retracement level, then I would take a buy from this point and buy all the way up to this area, because I know the distance from here to here, and that is the distance I will be selling from here, buying from here to this point. Okay, so now this is the beauty of the Fibonacci indicator. Now, I've spent a lot of time on Fibonacci. You can apply Fibonacci at any point and any level, and it is usually used to measure retracement. So if I take this, you can basically apply it anywhere. Let's just take a stab at any point on this chart right now. So I'm going to pick this point. Let's assume that retracement started from up here, and as far as we can see, this is where it got to. Okay, it has currently rested here for now. So you see that the retracement went a little, almost to 38, and then 250, all the moving averages are converging at the same point, which means the retracement is going to end at that point. So I would be looking for a sell opportunity down here, and I will sell for this distance, maybe up to this point here. Though it actually went lower than that, I would sell a little down to this point here, but it still went a little lower than that. So you can see how retracement works. The longer the retracement, the deeper the fall will be. Let us take a look at another section. Just pick any section. Let me take this, extend this to this point. So you see that Fibonacci works anywhere. As long as there's a retracement, Fibonacci would still work. So you see, I drop it here. Look at the retracement, 38 retracement. What happens? It pulled all the way down beyond that to this point, even up to this point, before it continued down again. So every time there's a retracement, if it's a true retracement, it's either going to bounce off 50, and then take note of this. If you have your moving averages right, your retracement will usually either bounce off 50 moving average, or 200 moving average. Worst case scenario, it will get back to 800 moving average. If a retracement breaks through 200 moving average and 800 moving average, then that's not a retracement anymore. It's a complete reversal. Let's take a look at this. We have an uptrend from this point here. We have an uptrend from this point here, but the moment it broke through this, it maintained an uptrend, and then we would expect that this will be a retracement. It retraced the first time to 250 and 20. It pulled back, and 14. It pulled back a little. He tried a second time, pulled back a third time, and then finally broke through all of them. This is why moving average is my most important indicator. You see, when he pulled and broke through all of them, he went back and retested them, failed at that point. You can see all those wicks gathering at this point. That is a failure. That is an indication of a rejection at that point. He rejected those moving averages there and broke at that point. He failed from that point. And once he fell from that point, watch what happened. He fell all the way down. Can you see? It just keeps falling. From that point on, it just keeps falling, and the moving averages started separating. So as long as these moving averages are staying apart, that is 800 is staying away from 200, 200 is staying away from 14 and 50, I'm going to keep selling this commodity. Okay, so this is the beauty of moving average as indicator. Now when you combine it with Fibonacci, it might actually give you a better reading. Now in the next video, I'm going to talk about a few of the other indicators briefly, because I've spent so much time on Fibonacci. And after that, we are going to see how we can take trade using this. We've talked about how we can take trades using this anyway. So, but I'm going to emphasize more on entry and exit of trades in a bit. So let's get going now.